Welcome to class 14 of Indian Financial System. In this class, in last class we have already studied the types of issues. So the main three types. So which are they? The public issue, right issue and private placement. And we have also studied the methods in the public issue. So here in this class, we are going to deal in detail about the mechanism of issuing instrument or the methods of public issue of shares or the different methods of floating or placing the new issue equity shares. So in that the main what we study is initial public offering. Okay. So before going to that, do you want to raise money for your business? If yes, then you can raise money from the initial public offering. So this is the best way to raise money if you want to grow your venture. Initial public offering or IPO is an offer in which company goes public from private means. In private limited company, only some people have ownership of company, right? But in public offer, anyone can buy the ownership of company. So a lot of people want to raise money through IPO process, but they don't want to launch IPO. So they don't know how to launch IPO or what is the process of IPO. So especially in India, what is the process of IPO? So today, in today's class, we are going to discuss everything. So that is regarding IPO. For example, how to launch IPO, what is the process of IPO in India. So in today's class, we will discuss the process and the requirements to launch an initial public offering. So before going to that initial public offering, so understand, when a company whose stock is not publicly traded, so and wants to offer that stock to general public, so normally what happens, if the company is in a stock exchange, listed in a stock exchange, so such companies are a public company, right? And company which are not traded in a stock exchange still, but they want to offer their stock to the general public, so it takes a form of initial public offer. So initial issues, which means initial issues are the issues of shares for the first time, either after incorporation or conversion from your private limited to your public limited company. So an issuer company makes an initial public offer of the equity shares. It may be through book building mechanism, and this book building and all I am going to deal in the next classes. Okay, so it can also avail an green shoe option. This also we are going to study in the next classes. So these are the facility for stabilizing the post listing price of its shares. Okay, so what is the meaning? What is IPO? So IPO stands for initial public offering. IPO is a process in which a private company sells their shares to the public for the first time. After becoming a public limited company, the shares of the company can be traded on the different stock exchanges. Thus, the initial public offering is a process of becoming a public company from the private company, right? So from public company you are going to convert it into the private company. So initial first sale of shares by private company or a public or initial issuers of shares for the first time. Okay, in other words, a public issue made by the company for the first time in its life, we call it as initial public offering. So it is nothing but the issue made by the company, which issue, the public issue made by the company for the first time in its life is called as initial public offering. So under this method what happens, so whatever shares are there, that shares are issued to appreciate on the basis of orders placed by them through the brokers. So which means the allotment of shares what are there, the allotment is made on priority basis. Okay, In this case, the job of selling the stock is entrusted to underwriters or the brokers. Okay, so under this method, on behalf of client, the brokers place order through, it may be computers. Nowadays it is taken in a computer trading system, right? Computer trading. So after finalizing the allocation of shares through the brokers, what they do, they are going to inform to their client to submit their application and deposit the amount payable through the brokers. Okay, so it broker, so we can say the escrow account, we say, right? So escrow, so what is this escrow and all? So escrow is nothing but a primary issue account, we say. So through escrow account to this clearing house. So escrow account means what? So the issuers opens a separate escrow account or primary issue account, we say, for a primary market issue. So the clearing house of the exchange debit the primary issue account of the brokers and credits the issuer's account. Okay, so that we call it as escrow account. So the broker in an escrow accounts to this clearing house. Okay, so the clearing house debits broker account and credits the issuer account. So afterwards the share certificates are dispatched to the investors. So this initial public offering is a kind of public issue of securities where an unlisted company makes either a fresh issue of shares or the securities or an offer for sale of its existing shares or both for the first time to the public. Okay, so what are the advantages? What advantages you see in your of launching your IPO? So the first is can raise a lot of money from the company. So number of benefits of launching an IPO is that you can raise a lot of money for the company. So why? Because you are going to get it from the public, right? So after becoming, or once the public, when we say private company, so they are not trading in a stock exchange, so which means they are not going to collect or issue the prospectus, they are not going to collect it from public. Suppose if they are planning to launch, or if they are going to issue through IPO, so then they can get lot of money for the company. The next is IPO gives your company more public exposure. So how? When your company listed on the stock exchange, so this will reach a lot of people. Okay, so it will give your company a more publicity. The next is IPO also reduces the cost of capital. So how IPO reduces the cost of capital? So it is because in publicly raised money, you don't have to pay the interest to anyone. Okay, so then the next is initial public offer also provides an opportunity for the existing shareholders or the stakeholders. Then after becoming, or it is easy to merge and acquire another company. How? So after becoming public limited company, so normally it is easy to become, or easy to be, to do mergers and acquire another companies, right? The next, what are the disadvantages here? It will take a lot of time to issue initial public offer, so which means it may take 6 months to 1 year for launching an IPO. The next, after becoming, or additional regulatory are and disclosure. So how? So after becoming a public limited company, you have to follow various additional, because public company have to follow various rules and regulations. It has been regulated. Suppose you are going to trade in the stock exchange, so SEBI is going to control you. So all these things, regulations, rules, everything will be there. So the next is underwriter's fee and auditor's fee or audit fee. So IPO involves a cost. You have to pay underwriter fee and audit fee. So in that sense, we can say it is very costly. then there is also a risk of losing the potential control, we say. So the share will be given to the public, right? So there will be risk. So in IPO the shares will be given to the public, so there is also a risk of losing the potential control. So control will be in the hands of whom? The public, right? So what happens? The ownership. So as I told you, a lot of people wants to raise money through IPO, and once it is done, what happens? The ownership, the control will be in the hands of people, right? Will be in the hands of people. So ownership of the company will be given to the people, but in private company what happens? You yourself are going to hold the ownership. The next process, we say. So process of IPO in India. So procedure. So first, under public issue, the new shares and debentures may be offered either directly to public through the prospectus or indirectly through an offer for sale. Okay. So involving the financial intermediaries. So now the main steps involved in this is you have to draft a prospectus. So prospectus means a invitation, right? So first you are going to draft it. So prospectus should be prepared giving all required information. So any company or a listed company making a public issue or a right issue of value more than 50 lakhs has to file a draft of offer document, so with SEBI. So for its what? For its observation. So the company can proceed further after getting observed from SEBI. The company can open its issue within 3 months from the date of SEBI's observation letter. Okay, the next we can see is your fulfillment of entry norms. So what are these entry norms? Norms means normally the standards, right? So there are some standards or norms which has been prescribed or laid down by SEBI. Okay, or we can say the parameters for assessing the primary market. A company can enter into the primary market only when they are going to fulfill these entry norms. So what are these entry norms? Entry norms are the eligibility criteria. So if you cannot eligible through the first requirement, then you can select the another alternative, we say. So there are two eligibility norms, right? So eligibility norms, first it says the company's net worth should be 3 crores or more in the previous fully 3 years. Okay, and whatever tangible assets you have, so that tangible assets must be of 3 crores in previous 3 years, and in which not more than 50% in the monetary assets. Okay, so next, the at least 5 crore average profit before tax for previous 3 years out of 5 years. So that should be there. So when companies wants to launch its IPO for first time, then the size of IPO is not more than 5 times or of its pre-worth valuation, or in case the change, or in case of change the company, the minimum 50% of revenue should become for proceeding 1 year for the activity denoted by the new game. Okay, the next, if we are not able to fulfill this one, so there is another norm, another eligibility criteria norm, or norm 2 we can say. So what it says? So it says, suppose the companies who want to raise a large capital or fail to lay down any steps which I have said so far, so then the SEBI, they are going to provide another alternative, and that another alternative is book building route, in which 75% of net offer allowed to the company is mandatory allotted to qualified institutional buyers. Okay, the next is appointment of underwriters. Okay, so suppose you are going to issue IPO, or any company wants to launch an IPO. So it has to have an investment banker. It also could be a lead manager, underwriter, merchant banker. So there can be more than one investment bankers also. Okay. So in some cases, underwriters makes a promise to subscribe at least a fixed percentage of unsubscribed shares on some terms and condition basis. So it depends upon the underwriters whether they promise or not. So let's understand this with example. Okay, a company wants to issue 10,000 shares to the public, and an agreement is signed between the underwriter and company that underwriters will provide a guarantee to subscribe at least 50% of its shares. So that is 5,000. Okay, if the public didn't subscribe the 5,000 share, underwriters will buy the remaining shares. So underwriters will also make a draft prospectus, and the prospectus of document is a document so issued to the public, as I said you, when they are going to launch the IPO. So in prospectus all details relating to the IPO will be mentioned. Okay, so the next is your, I said, underwriter, right? So they are going to give the full assurance, or they are going to ensure the full subscription. Okay, so the next is appointment of banker. So appointment of banker, generally company shall nominate its own banker, so to act as a collecting agent. Collecting agent means here debt collector. Okay, so they are going to, that banker is going to act as a collecting agent. The banker along with their branch network, so process the funds procedure during the public issue. The next is initiating allotment procedure. Initiating allotment procedure means when the issue is subscribed to the minimum level, the registrar initiates the allotment procedure. So minimum subscription should be mentioned in the prospectus. Okay, so minimum subscription means what? So it is a minimum amount which in the opinion of board of directors must be raised by the issue of shares, so that the company has a necessary funds to carry out its objective. Okay, so the next is appointment of bank broker to the issue. Okay, appointment of broker to an issue. So recognized member of a stock exchange can be appointed as a broker. Okay, who can be the broker? Only the recognized member of stock exchange can become the broker to the issue. So recognized member means who? The one who is given the license to participate in the security market. So membership is open for corporate entities, individual and partnership firms, so who are going to fulfill the eligibility criteria laid down by SEBI. So whatever eligibility criteria I have said you, right, the norms, so if whatever laid down by the SEBI, if they are agreed to fulfill that, so they can be the member. The next is filing a document, right? So document such as a drafted prospectus along with the copies of agreements entered into with the lead managers, underwriters, bankers, registrar, so brokers, so to the brokers to the issue, so have to be filed with the registrar of the company. So the next is your printing of prospectus and application form. So after filing all these documents, the prospectus and application form will be printed and dispatched to all the merchant bankers, underwriters and bank broker to the issue. Okay, then the next is listing the issue. Listing the issue means what? You are going to list the issue. So listing in the stock exchange. So what do you understand with this? Listing application to stock exchange. So when a draft of prospectus is submitted to SEBI, so meanwhile a company can apply to the stock exchanges to list their stock. Okay, so there are 24 stock exchanges so available in India. So National Stock Exchange is there, Bombay Stock Exchange is there. So Stock Exchange of India are the most popular stock exchanges in India. Okay, here There are also eligibility criteria for listing your shares, okay, in National Stock Exchange. So for list your company on National Stock Exchange, the minimum paid up capital of the company must be 10 crores, and the capitalization of the applicant's equity shall not be less than 5 crores. Okay, so you are going to apply, very essential, to send the letter to the stock exchange concerning where the issue is proposed to be listed, right? If you are not going to list your shares, so then you cannot trade in the stock exchange. The next is allotment of, publication in the newspaper. So next step is your publication in newspaper to publish the prospectus and communicating, sorry you are going to publish your prospectus. You are going to give the starting date and the end date of issues in the newspaper. The next last is your allotment of share. So after close of the issue, as I said, in publication of issue, they are going to clearly mention the opening date or commencing date and the closing date. Okay, so after the closing date of issue, all application forms are scrutinized, tabulated, and then the shares are allotted against those application received. So these are the process how IPO is launched in India. Thank you.